Inflation in the Philippines has hit 7.2% in April. Significant increase siya from 4.1% noong March. The spike was mainly driven by higher food, transport, and utility cost, largely due to supply pressures caused by geopolitical tensions sa Middle East, which have led to higher global oil and fertilizer prices, as well as a weaker peso. So anong ibig sabihin nito? It means that compared to the same period last year, the average prices of goods and services are now 7.2% higher. So kung may binili ka dati for 100 pesos, nasa around 107 pesos na ang kailangan mo ngayon for the same item. Mas mahal na ang food, gasolina, utilities, transportation, at halos lahat ng daily expenses. And if your money is only earning less than 5% yearly in a regular savings account sa bangko, unti-unting nababawasan ang purchasing power ng pera mo over time. And things could still get worse if tensions in the Middle East continue to escalate. According to HSBC, Philippine inflation could climb above 8% if tensions in the Middle East continue to escalate. The bigger risk may not just be oil prices, but food inflation. As a result, the BSP may be forced to hike policy rates to as high as 6%. To keep up with high inflation rate, ideally, we need a total return higher than the inflation rate. At pag nag-invest tayo sa dividend stock, total return comes from two things: dividends and capital appreciation. That's why I prefer companies that pay me dividends while I wait for the stock price to appreciate. If a stock is giving a dividend yield of above 7.2%, may panlaban ka sa inflation rate ngayon, even before pa tumaas ang share price ng stock. Preferably 8% or higher to keep up with increasing inflation. Kaya kung meron kang pera account sa DragonFi at pera accredited ang dividend stocks na bibilhin mo, you can enjoy tax-free dividends. And if the stock price eventually appreciates over time, that's an additional upside on top of the dividend income na makukuha mo. Before I continue, quick shoutout muna sa mga bagong YouTube channel members ko. Kay Joshua D, I am Jordan Andrews, Barga Baroga, Richie Rodriguez, Primrose, Emily Rodas, Kaambay K, and Joanne Peconcillo. Maraming salamat for joining as channel members and supporting my YouTube channel. I really appreciate your support. Let's continue. In this video, I'll share 7 stocks with high dividend yields that can help us keep up with increasing inflation, while also offering potential for capital appreciation over time. Based on the TradingView screener, VREIT and VLL currently offer the highest dividend yields in the market. However, personally pass ako sa dalawang stocks na ito. Even though the dividend yields look attractive, I consider Villar stocks relatively high risk. Baka may magtanong din ng SCC and DMC. Historically, SCC and DMC have been among the top dividend-paying stocks in the Philippines. Kaya lang marami pa rin silang headwinds sa ngayon. That's why I decided not to include them in today's video, mainly because of the ongoing uncertainty surrounding SCC's Coal Operating Contract or COC. For now, let's focus muna on companies with clearer business visibility, more stable outlook, and consistent dividend history. Let's start with PLDT. PLDT is the Philippines' largest fully integrated telecommunications company. It provides a wide range of telecommunications and digital services across the country. Meron siyang market cap of 271.15 billion pesos. Dividend yield is 7.64% based on current price of 1,231 pesos. PLDT has a strong dividend-paying track record, having distributed dividends for 32 years. Historically, mas mataas ang dividend payouts ng PLDT from 2013 to 2015. Pero bumaba ito as the company increased capital expenditures to expand its network infrastructure and invest heavily in fiber and digital infrastructure. So while PLDT may not currently be a strong dividend growth story, it remains attractive to income investors seeking stable and recurring dividend payments. Twice a year ang payout ng PLDT, April and September. PLDT's dividend payments are supported by both earnings and cash flow. Kaya lang mataas ang utang ng PLDT because of heavy capital expenditures. Ang kanyang debt-to-equity ratio is 230% with cash of 12.24 billion pesos. Acceptable pa rin naman ang interest coverage ratio niya at 3.4 times, which means that PLDT can still comfortably pay its debt obligations. Key risk to watch is rising interest rates kasi companies with high debt levels are more sensitive to higher borrowing cost which could pressure earnings and cash flow ng PLDT. Next is Metro Bank. Metro Bank is one of the largest banks in the Philippines, offering a wide range of financial services including corporate lending, consumer banking, credit cards, investment banking, and wealth management. It has a market cap of 297.28 billion pesos. Metrobank has a dividend yield of 7.69% based on 65 pesos na share price. It also has a long dividend paying history, having distributed dividends for 32 years. Semi-annual ang payout niya ng dividends, March and September. Napaka-healthy ang payout ratio ng Metrobank at 27%. So well-covered ang kanyang dividends by its earnings and marami pang retained profits for future growth. May potential pa for dividend increase. Even the projected payout ratio by 2029 remains sustainable. Metrobank also has a strong balance sheet. Perfect 6/6 ang financial health score niya. It has a healthy asset to equity ratio of 9.3 times. Manageable din ang bad loan ratio of around 1.7% with sufficient allowance for bad loans. PLDT and Metrobank are attractive options for pera account. Kasi dividends earned through pera ay walang 10% tax. So investors can receive the full dividend yield, which is good for long-term compounding. Next is LTG. LTG has a diversified portfolio of consumer-focused businesses, which includes banking, tobacco, distilled spirits, beverages, and property development. LTG has a market cap of 164.41 billion pesos. LTG has a dividend yield of 8.28% based on 15.10 na share price. It also has a long dividend paying history, having consistently paid dividends for 20 years. Quarterly ang dividend payout schedule niya. And for this year, 2026, nagbigay na siya noong March. So most likely, June ang next payout. So sana may increase na ngayong June since strong naman ang performance nila noong 2025. Dividend payout ratio is 43.67%, which is still considered healthy. So may room pa siya to increase dividends. So healthy rin ang balance sheet ng LTG. Mababa lang ang kanyang utang at 13.77%. Meron din siyang very large cash position of around 349.72 billion pesos, providing strong liquidity and financial flexibility. Next stock is Centro Escolar University, CEU. Centro Escolar University operates educational institutions sa Manila, Makati, and Malolos, Bulacan. It has a market cap of 7.53 billion pesos. So, small cap company siya. CEU has a dividend yield of 8.35% based on 16.76 na share price. It has been giving dividends for 30 years. Kaya lang nag-skip lang siya magbigay ng dividends noong 2020 kasi nagka-pandemic, kaya affected ang earnings niya. Kaya lang once a year lang siyang nagbibigay ng dividends. July ang usual payout schedule niya. So malapit na rin siyang mag-declare ng dividend for this year. CEU is not pera accredited, so sa regular account lang siya pwedeng bilhin kasi hindi siya available sa pera. Mataas ang dividend payout ratio ng CEU from its earnings at 94%. However, mas mababa ang payout ratio niya from its cash flow, nasa 78% lang, which means that the dividend is still supported by actual cash flow generated by the business. Although CEU's earnings payout ratio is relatively high, ang kanyang free cash flow and operating cash flow remain stronger than its reported earnings, which is ideal. This shows that CEU is generating healthy cash flow to support its dividend payments. Napaka-healthy rin ang balance sheet ng CEU. Zero debt. Wala siyang kautang-utang with cash of 2.12 billion pesos. Overall, financially healthy ang CEU. Kaya lang mababa ang liquidity nito. Kokonti lang ang nagtitrade ng CEU. Kaya hindi rin masyadong volatile ang share price niya. Medyo mahirap mag-exit pag malaki ang position mo dito. Next is RFM Corporation. RFM is a consumer-focused company engaged in the food and beverage business with well-known brands across pasta, milk, ice cream, and flour products. RFM has a market cap of 18.6 billion pesos. Small cap din siya. RFM has a dividend yield of 9.09% based on 5.55 share price. Meron din siyang long dividend paying history, having distributed dividends for 28 years. Quarterly payout siya, pero last year nakalimang payout siya. This year nakadalawang dividend declaration na rin siya, February and May payout schedule. Higher versus same period last year ang dineclare niyang dividends this year. Mataas ang payout ratio ng RFM from its earnings, nasa 97%. However, its payout ratio from its cash flow is lower, nasa 84% lang, which means RFM's dividend is supported by actual cash flow generated by the company. Its free cash flow and operating cash flow remain stronger than its earnings. This shows that RFM is generating strong cash flow to support its dividend payments. Net earnings usually include non-cash expenses such as depreciation and other accounting adjustments, which can reduce reported earnings even if the company is generating healthy cash flow. Ayan, napaka-healthy rin ang balance sheet ng RFM. Ang baba lang ng debt-to-equity ratio niya at 6.5% with cash of 5.29 billion pesos, giving the company enough liquidity and financial flexibility. Next is OceanaGold Philippines, OGP. OGP is a gold and copper producer operating the DDPU mine in Nueva Vizcaya. The company benefits from higher gold prices, which can support earnings and dividend payouts, especially during periods of economic uncertainty and higher inflation. Ang kanyang market cap is 85.05 billion pesos. OGP has a dividend yield of 9.62% at the price of 37.65. Quarterly ang payout niya ng dividends. OGP has a dividend policy to distribute at least 90% of its free cash flow to shareholders. Currently, its cash payout ratio is at 75%, which is within the company's dividend policy. OGP's earnings payout ratio exceeds 100%, but this doesn't mean na risky ang kumpanya. So, makikita natin dito sa chart na mas mataas ang free cash flow at operating cash flow ng OGP compared sa reported earnings niya. This explains why OGP can sustain its dividends despite having a higher earnings payout ratio. For mining companies like OGP, reported earnings can be affected by large non-cash expenses such as depreciation and other accounting adjustments, while operating cash flow reflects the actual cash generated by its core business operations. Ideally, operating cash flow must be consistently higher than its reported net earnings. This shows that the company is generating strong cash flow. Napaka-strong din ang balance sheet ng OGP, so wala siyang utang. And then meron siyang cash of $124.3 million. Overall, financially healthy ang OGP, which gives OGP more flexibility to sustain operations and dividends even during volatile market conditions. Kaya lang, OGP is a cyclical stock. Ang earnings niya largely depend on gold prices. Kapag malakas ang gold prices, strong din ang earnings and cash flow ng kumpanya. But when gold prices weaken, hihina rin ang earnings and dividends niya. Next stock is SPC Power Corporation. SPC is a power generation company engaged in the generation and sale of electricity in the Philippines. Ang operations niya ay mainly in the Visayas region, particularly Cebu, Iloilo, and Bohol. It has a market cap of 15.89 billion pesos. Small cap company rin siya. Dividend yield is 11.54% based on 10.4 share price. Kaya lang bumaba ang dividends niya noong 2022 and 2023 kasi bumaba ang earnings niya noong time na yan. And then nag-increase ang payout niya noong 2024 and 2025. And twice a year ang dividend payout niya. Dividend payout ratio niya from its earnings ay 52%. So SPC's dividend payments are well covered by its earnings. Napaka-healthy rin ang balance sheet niya. Zero debt with cash of 6.99 billion pesos. Hindi pera accredited ang SPC, kaya sa regular account lang siya pwedeng mabili. So yan ang 7 Philippine stocks that can potentially help us keep up with inflation while also offering potential capital appreciation over the long term. Reminder, this is not a recommendation to blindly buy all of these stocks. Every company has its own risk. So it's important to do your own research and due diligence before investing. Pwede ka mag-set ng sarili mong buy below price based on your target dividend yield. The dividend play valuation method is a simple way that you can use to estimate your buy below price based sa iyong target dividend yield. This method works best for stable companies. Ang kanyang formula is annual dividend per share divided by your target dividend yield. If you want to be more conservative, pwede mong iset ang target dividend yield mo to 8% or higher. At kung wala ka pang account sa broker at gusto mong mag-invest sa dividend stocks, pwede ka mag-sign up sa DragonFi Securities using my referral code MoneyWise. Thanks for watching and see you in the next video.